What's up, everybody? Rick here at Bear Forex. Thanks for stopping by to check out the latest Bear Forex topical video. First things first, I do not endorse or recommend anything I discuss here. It's simply information and my experience using any particular style, indicator, or system. Today, I'm going to talk about Bollinger Bands, or Bollinger Bands, however you want to say it. Now, the Bollinger Band was designed and created by this man, John Bollinger. John Bollinger is a financial analyst and a book author. He wrote a book called Bollinger on Bollinger Bands in 2001, and I read it. I found it at a library. I didn't pay for it, but I did read it at the library. But the B bands themselves have been around since the late 80s. He has, or had, I'm not sure if it's still around. I tried to research it, but it was kind of hazy. But he had a newsletter called Capital Growth Letter, and has been around since 1988, and had thousands of subscribers. Today, though, it seems more he's focused on his website, which he has his own official website. As far as the indicator is concerned, it seems to be as popular as any other mainstream indicator. It's available in nearly every basic platforming package. I've never seen or heard of anyone, whether it be like MetaTrader or MetaQuotes, Awanda FX Trade, or anything like that, TradeStation, anybody, and I've never not seen it, and everybody has it. It's a basic indicator that's everywhere. There are many articles, forums, and websites that are dedicated to this Bollinger Bands thing. People seem to really like it. I don't have a problem with it so much as I just didn't really care to use it all the time on longer time frames. My opinion is it's good for short time frames for all you people who like to trade shorter time frames. So for anywhere from tick chart to maybe an hour max. That's my recommendation. That's what I say, right? People are going to say, no, Rick, it works good on this, that, or the other thing. I'm just talking about my experience. I've never used it on anything. I did used to use it on 15-minute charts when I used to trade back in the days. I used to trade the first few hours of each session. So the London session, the New York session, the Asian session, I used to trade the first few hours using 15-minute Bollinger Bands, which later in this video, I'm going to show you how I traded it and how I used to use it. Whether it conforms to what the norm is or whatever, different story. But with that being said, let me explain a little bit about what it is. Basically, Bollinger Bands are, it's a 20 SMA with 2 standard deviations of 2.0 each. If you don't know what that means, go look it up. I'm not going to sit here and explain what deviations are, but basically they're the lines that mimic the way that the SMA in the middle is moving, and basically that creates 2 boundaries. And the theory behind it is that 80 to 90% of all tradable price action happens in between the upper band and the lower band. That's like the most street way I can tell you, though, in layman's terms. So most trading action will happen in between those 2 lines. Now, the only problem with that is that when the market starts to trend, it goes down and there is no more between the 2. It just starts falling or rising, which I'll show you later when we get into some charting. And that's the part that you basically have to throw away what the Bollinger Band does. Because then you're like, oh, well, now it's a breakout, so follow that breakout. And that's not really what Bollinger Bands is. When in the writing, it says a majority of the price action is tradable in between the 2. So basically what it is like anybody who's actually sat there and did some chart watching for a while, which is totally necessary in order to become a good trader. You can have the best trading system or methodology, but you really need to know, you need to learn how the markets move in terms of, like, when I was originally taught by one of my mentors, he would drill into my head about the waves, and not Elliott wave theory or anything like that, but literally like waves. You'll have a big up move followed by a big down move, followed by a mid-sized up move, followed by a mid-sized down move, followed by a small up move, down move, up, down, up, down. That's the part where the water is kind of calming down, and then somebody will throw a rock in the water, and boom, it'll happen again. And it happens over and over and over. And your job is to catch some of the water as much as you can. As the wave goes up, you grab some, and the wave comes down. That's what originally attracted me to Bollinger Bands, was because one of my mentors, he taught me that, right? And I was like, oh, well, I read that's what Bollinger Bands does. Bollinger Bands is you go up and you go down, you try to grab some in between the lines and blah, blah, blah. But then there's always something, right, with no matter what system. So with this one, its weakness is if price starts to trend, what are you supposed to do? There's things you can do, and I'll talk about it later. But basically, that's what it's for. It's for ranging markets and markets that are, doing that up, down, higher lows, higher highs, like that, right? But a big sweeping up move with no retrace is very hard to use Bollinger Bands, in my opinion. And because I didn't use it for a decade or decades and decades, I don't even really use it now anymore at all. Sometimes if I feel like I'm in the quote unquote gambling mood and I go down to the 15-minute charts, I may still throw it on there to see, hey, maybe can I scoop up some dinner money, or I want to buy a new video game, or whatever the case may be, and just nonsense. Just want to play around a little bit down in the 15s. Sometimes I'll throw it on there. Anyway, but something to understand is that the 20 SMA, the standard of what it is, it's highly adaptable. Meaning, Bollinger himself in his original work said to play around with the numbers until you like it, right? So 20 is the standard. 20, if you put on, if you watched another one of my videos, when we talk about the moving averages, we talk about moving averages, the 20 SMA, if you put that on a weekly chart, that's 20 weeks. You put on a monthly chart, that's 20 months. But that's neither here nor there. Let's not get into that right now. The point is that you can spend a lot of time trying to find what fits. I've always myself just used the standard 20. Of course, back then I wasn't as knowledgeable as I am now, but it still worked fine. 20, 15-minute moving averages for me. Now, as I think about it, it went on the 15-minute chart. That's a couple of hours. That's enough time to understand which way the market's moving in that short amount of time, because I'm trading a 15-minute time frame. So it's not really good for trends, in my opinion. It's more for ranging markets. For example, if price falls below the lower band but keeps falling instead of bouncing back up, how are you supposed to trade that? You have to wait. You basically trade it from band to band, like I was saying. Take a look at this screenshot here. Let's see. So this is the one. This is a shot of the USD/JPY on the daily charts from data using my broker Owanda. And this screenshot covers about 7.5 months across 2018 and 2019. Now, I put a bunch of tags all over the place, but each of the red arrows represents what I interpreted as a valid, high probability short trade, according to basic rules, as I understood them. Now, the green up arrows represent valid, high probability long trades. The yellow arrows are higher risk trades. I remember reading someplace, and I tried to find it on his website, and it could have been someplace else, so don't quote me on this, but I remember it somewhere saying if price approaches the deviations on either side, the upper band or the lower band. I was trying to find it again. I don't know where I found that. I went through the Bollinger.com website, and I couldn't find it under his 22 rules of trading Bollinger Bands, which if you visit his website, BollingerBands.com, You'll be able to find the 22 rules he officially created for use of this. I will link that in the description. So something else to understand is that the Bollinger Band is not a standalone indicator. It's not like Ichimoku. It needs help. You have to have. You don't have to, but it's highly recommended that you have. And this is according to him too. I know people who trade it by itself, but I don't recommend it myself, especially if you're new. Before I forget, so if you see like the yellow stuff, the yellow marks there, they don't always work out. And then you can see, how in the area where price starts to come down, there's like that big down move. There's 2 entries to get in, but the price doesn't go anywhere. So those are two big losers, right? And there's, it's one loser really, and then the second one, when you get it, it kind of floats up, and you can make it up to the top, or at least to the midway bar there. But that's the way that I understand it to be traded. And that's the way I used to trade it. And I'll show you in better detail with some indicators when I fire up the charts here in a second. Now I have used 3 in my past trading of B bands, and it's just basically based on experience, and I just kept using different things. MACD, RSI, and Stochastic. Those are what I use the most. I myself like the Stochastic the best myself, but that's just me. Now I never used B bands beyond 15-minute charts for live trading. I've tested it like hourly and all that stuff, and I just thought, wow, well, this is going to take a long time, and I just didn't want to do that anymore. So, but I'm going to fire up my charts and show you how I traded. One sec here while I fire up my charts. Check, 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 check. All right. So here we are. This is the Euro USD on the 15-minute Awanda, and this is just some I just grabbed whatever random screen that looked pretty good. It has pretty much everything that we'll need here. So trading it alone is basically, I don't recommend it, but you can see here. We'll use this area right here. So we'll see that once price right here bounces. So technically price touches that, and you're supposed to go long on the next up candle. So that would be this one. Now you have 2 options. Either you can set your take profit for the middle, which would be silly here because you're getting in right here. Or you can set your take profit to the other side, which if you did so on this particular one, you'd go along here and you'd probably hit right here about 2 hours later. Bam. Now, here is the other thing. You can, because it touched here, you can short it here, which will end up in a loser and so on and so forth, which is why you need something to tell you about price, right? But I wanted to show you over here, which this is probably the same picture as before, but you can see as price goes down, it closes underneath, right? So you're supposed to now wait for an up candle, which none happens until right here. This is an up candle and it closes inside and you hit long. Your target can be when it reaches this middle bar or when it reaches the high bar, any way along this. Now that's the hope, right? The problem is price continues to go down. Price bounces along. You should have actually got out anyway because it's struggling along, but price comes crashing down. and then you get out again. Now you have to wait and wait and wait. Price spikes through, next up candle, take it here. Your goal is this line. Well, it never makes it to that line because it comes crashing down again. Spike, wait for up move. There it is again, up. Here's your target. Bam. This is the way Bollinger Band works, okay? At least the way I understand it and the way I traded it. And it just happens like that over and over again. What you want to wait for, the better signals, is when price actually spikes out and then comes back in. So when you see a move like this, price comes out all the way, then price comes back in all the way. And you can go long here and either set your target for this or this, right? Now, this is what I mean about approaching. So if because somewhere, like I said, and I never found it again, I don't know where the hell it went, but price approaches the upper band. You see how price approaches the upper band? This is it approaching this long spike here. It never touched it and it never protruded out of it. Okay? So if you were to take this short, and you know what? This candle, because it's a long, that sword, it looks like more pressure to the downside. And you know what? It did fall a little bit. However, if you went and took this trade and you shorted it, your target is going to be either here or down here, and it's just kind of going to mess around a little bit. And sure, you would have made a couple of points, but if you look more times when price spikes out, like look, you can see it here, it happens. Price spikes out and then spikes back in. You short here if your goal is right across from it. Bam, it hits it. Now, I know this is 15-minute, but it doesn't matter. It looks the same on any other chart. Look, I'll put it on the daily, and it's the same thing, you know. Price spikes out. Right here, your price spikes out, bam, you go long, here's your target. Yeah, it just takes more time to get to that target, you know. That's all it is. But if you see here, when price protrudes out and you wait for price to close back in, it's a better, more valid signal. More times than not, it comes back down. And it's because these upper bands are basically dynamic support and resistance, according to the Bollinger Band calculations, right? So if price makes it up there, then comes back in, like this one is a rough call. You could have taken it here or waited for this. But if the middle band is your target, well, look at that. You hit the middle band. And then if you wait for price to which it did, it went back down. Now this one, right, you can either short it here because it crossed the band, but then you would have ended up losing. Or you wait until price comes back up like it did here. Oops, sorry about that. And then you hit the button and you wait and bam, it hits your target. That's the way that I used to trade. I didn't trade all the way across. I traded from point A to point B. I didn't do A, B, C. So that's the way that I traded. Let me move back to 15 here. To wherever it ends up, doesn't matter. We'll just end up anywhere. Oh, here's some good volleys here. Here's some good volleys. So what I'm going to do first now is I'm going to show you, again, I always traded it with something. I used either MACD, RSI, or Stochastic. Now, Stochastic was my favorite one, but I'm going to go through them all. So I just showed you without anything how it would be traded, right? And that I prefer to trade from point A to point B. So in this example, price spikes upward, price closed under. I'm going to hit my trigger. My target is right here. Okay, and bam, it closes 14 points. Then, if I was feeling it, right, I may have taken this one. 1 to 2, right? And then I wait for this price to come back up. It spiked out. I wait for price to come back, hit it to right here. Bam, got it. Okay, so now I'm waiting. Okay, price comes back up. It crosses the line. Bam. This is my target. It never reaches. But after 1, 2, 3, 4, 5 candles that just didn't make it, I would have closed it somewhere in here, somewhere in this little area. May have lost one or two, or gained one or two. It just took too long, and price just doesn't want to leave there, which is again why you need to understand candlesticks and how they move. So my next one would be here, from here to here, bam, that's another 10. Then you wait some more. Oh, it crossed out, came back in, here to here, bam. Okay, price closes above, take it here, up to here, and it just hits it a little bit later. And that is how I used to trade Bollinger Bands. Now, I will show you over here. This is the part I don't like about Bollinger Bands, right? You can use this as a secondary kind of, like if you're looking for breakouts, right? Price breaks out, and that's supposed to be your opportunity to trade, right? So it was like you would execute your trade here, and you would stay until price dipped back in, which in this case, it would have been a loser. And then what about this? When price doesn't extrude out, right? It doesn't come back, it doesn't go all the way out and back in, okay? So this is the part I did not like about Bollinger Bands, this stuff, right? Because this is where you get killed. This is easy stuff right here. All this is exactly what it's made for. Bounce, grab, yay, 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 so happy. Shit all over yourself, because now you just lost everything you freaking made. And you can tell, see, this is during between 6 and, yeah, this is during the daytime, New York. That's when this crazy stuff happens. So it's better actually to trade this off peak times. But yeah, so like let's use the same rules as before, right? Price breaks out, wait for it to get back in. Okay, bam, this is my target. Oh shit all over myself, no good. Lost money. Bounced out, waiting for a green candle. I'll take this one, that's fine. Oh shit, I crapped all over myself. Price goes out and in again. But this is the risk that you take when trading this one. It's also why I like to have another indicator to help out. See what I'm saying? So I'm going to put an indicator to help. And the indicator we'll start with MACD. All right. Just the regular old MACD. All right. Moving average convergence divergence. Now, I was never a big fan of this indicator. I know a lot of people swear by it. I personally don't really care for it too much, only because I think it takes way too long to develop. But it is a good way to kind of get your confirmation that the market is moving in the direction that you think it's moving, right? Now, the only thing that sucks is when these bands are tight like this, you can see over here, it's not easy to read, So, although you can still trade it from point A to point B, and from point B to point C, and then C to B, and B to A, you're not going to get the good confirmations down here, So you can't rely on it as a confirmation because it takes so long to develop, you see. Now, with big moves like this one, it's easier because there's so much movement, so much big data moving. Obviously, this is a downtrend, and it didn't take that long to develop. Or not to develop, but it didn't take that long to for this thing to agree, right? What the best time for it, though, is stuff like around here when it's like this, you see. So here comes prices coming down, right? Now, right here, it starts to weaken according to MACD. See how it changes to a lighter color? So starting to weaken as price bounce back in is one way to do it. Otherwise, you'd have to wait until price is above. See the little green and blue is above red. When all that happens, now it's okay to go long. Okay? So, but by the time you wait for it, it comes down and it's now short, but it's all too late. You see, that's the problem I have with MACD. It takes too long to develop. Like over here, it's telling me, no, it's not quite time to go long yet, but it is. It is, and that's the problem. By the time it tells me it's this one, okay, it's a red candle, gotta wait. Here's the next one. All right, so you can get in now, which it saved you some heat because this candle here, but this is not always the case. And then also because it's so like, it doesn't take that long. So once you hit OK here, let's say you just took this trade here, and this is your goal. Let me do this. Trigger it, and your goal is somewhere up here. Okay, and you're listening to MACD, bam, it gets hit up here, right? So now it's saving you from going short, except that over here it's still saving you from going short. But if you did go short here, you would have made your points because this would have spiked down and got you. You see? So according to the MACD, you should not be shorting at all, right? So I'm just showing you that if you're going to listen to MACD, you're going to miss a few, and it might be okay, but you're not going to be able to trade anything on this particular angle until right here. So now it's saying that it's okay. So anytime you're ready, you can start shorting once price crosses line B. And there it is, right here on this. Let me zoom in a little bit. It crosses line B right here. The problem is, as soon as you get to line B, it's still telling you it's okay, but it's not okay because price starts moving against you. So while MACD is one of the most popular ones, I don't recommend MACD, even though it says everywhere you look, oh, use MACD or RSI. From experience, I say don't use MACD with Bollinger Bands. That's my experience. Don't use it because it just takes too long to develop. Okay? Now, next we're going to move on to RSI. Sorry, hang on. Relative Strength Index. Ew. Ugly purple. That's okay. But I'm going to put a 50 line here in the center. All right. So, I don't know why they like to do purple on purple, but it's fine. So this one, RSI, to me works a little bit better than MACD because it's a little bit more reactive. Now I like to keep it on 14. Some people like to do 8 period. I find 14 is the best for using it on here for Bollinger Bands and a few others, but Bollinger Bands, it works pretty well. You know what? I gotta have to change this color because it's purple on purple, and I don't even know if you guys can see it. So I'm just gonna change it to white, thicken it up a little bit. And there we go. That looks a lot better. All right. Using the same thing. Okay. See how price bounces here out. And you want it to bounce back in. Now, traditionally, you either wait for price to bounce off the 30 or cross the 50. That's generally speaking. When using it with Bollinger Bands, I recommend that if it's pointing in the direction of the direction you want to go, I say go for it. Obviously, if it crosses the 50, that's even better. But because we're using Bollinger Bands, and Bollinger Bands has to go low before it goes back up, for me, if it's pointing upwards like this is, it's okay to go for it, especially since I went from C to B to A. I rarely ever went all the way across unless you're like in a Bollinger Squeeze, like this area here where price is tight. So my recommendation is that if it points up, that's the way I used to do it. So here, price comes down, it doesn't hit 30, okay? Or even here where it does hit 30. When price closes back up, look, it's pointing upwards. I'm going to take the shot. I'll go long here to here, okay? Bam, I'm good. Then, once price goes up here, it's above the 50. So, technically, it's above the 50, and this is not, so it's not showing as oversold. So here, and here's your target, but unfortunately it collapses. Okay, but here's the kicker. Since it collapsed, you close here, and you're looking, oh look, price is below 50, and it's pointing down. Take the shot. Bam. Bam. There you go. Right, so this one, price is pointing down. This one, at the time, price is going to be flat. Remember that these all these moves, so it wasn't looking like that at the time it happened. It was flat, and you'll know that from experience. Once you have watched this stuff enough times, you'll know what it looks like. But this one would have been pointing up. So this one's okay. So you take the shot and you take it to here. At least I would have taken it to here. Bam. Now this one. When price closed on this one, this would have been flat and not pointing upwards, which I would not have taken that. Okay? And I would have waited, and I see the price spiked but didn't go, and then I wait for this one again. Now this one again, 3 times in the same area, I probably wouldn't have taken it because price spiked again in the same area. So I would have missed all this, and I would have waited until price spiked out like this on this one. So price goes up over there, and then it comes back in, and the market's pointing down. So I would have taken this, and usually my stops would have been, like 15 away or so. Yeah, about 15 probably. That would make sense. So price would come down, and this is where my target would be. But here's the thing, and I'm going to hear shit about this, and I don't really care. If this 20 line is your target, then you have to move it along with the 20 line. So instead of it being here, it's going to be here. And once it's here, you can see that it gets hit. If you don't, and you leave it where it is, and price spiked down, it would have never made it, and you would have lost. Now, I know people are going to say that old adage, oh, never move your stop. Well, you know what? I want to get paid. I want to make some money. So you got to make sure you not buy into any of that nonsense, okay? If your target is this floating 20 SMA, then you make sure you move your stop and your targets along with that SMA. That's what makes sense. Not moving it and being stiff. Oh, no, because now it's dynamic. It's a dynamic support and resistance. If dynamic support and resistance is moving, what makes you think your price target is valid anymore? No. Either close your trade or move it. If you move it, it would have got hit. If you didn't, it wouldn't have. Okay? And then, so that's how I would do it with SMA. Obviously, if price is overbought or oversold, you react accordingly, right? So, for example, this one spikes up, it's oversold. When price comes back in, it's pointing down, boom. This is your target. Follow it till it gets hit, okay? If it crunches and shrinks, oh well, that's your profit target, okay? Now, last but not least, I'm going to pop in this stochastic here. They really like purple on at Trading View, huh? Excuse me. Okay. Now, this is my favorite one to use. I've always liked this indicator. I don't always use it, but I always liked it. I always thought it worked pretty well, so long as you paid attention and knew what you were doing. In terms of how to trade it, It's similarly like the RSI in terms of this is the highest, this is the lowest. And the best thing, in my opinion, and the most valid trades are the ones where the blue line dips below 20 or above 80 and then comes back in. Those were the best. Those were the best ones. And you're basically looking for confirmation bias, right? You're making sure that price is moving in the direction that you think. Now the RSI is a little bit more clear, a little bit more crisp in its because it's more reactive though too. So especially on like 15-minute charts, I actually use the Stochastic more so than RSI towards the end. But we'll just do the same numbers again. Okay, so here price comes out. So you're waiting and see how it dips out. And now as it comes back in, you look down here. The blue crossed the red, although it didn't go all the way above in. For me, I still would have taken it because it's showing me, even though the Stochastic is slower to react. I mean, you can change this to 8 if you like. I like to keep the 14s, but you know, it's not going to make all that's going to happen is that it's going to make it more reactive. I think 14 is the best one in the middle, right? So I would have taken it because it's not showing me that it's going down. So I would have taken it. Same thing to this bar, right? Now over here, because price is pointing up, again, I would have taken it. All right. And it would have closed here because price dipped below, and that's it. It's not working. It's failing. And it crossed that 20 line. Now, if you look down, you can see price move. This is pointing down also. The blue line's pointing down. It may not have fully crossed, but it's pointing down. So that's giving me the same go signal as I had with this one. Okay, price dips down here. Now this one, this is the little bit of the issue, is that it's not reacting fast enough. Again, it's not reacting fast enough. The RSI, again, it reacts faster, but the issue with it reacting faster is you'll get more false positives, right? Now, right here you'll see that as price has actually spiked all the way under at the end of this candle. But when this candle closes, this is what happens. You see this part, okay? That's what I want you guys to make sure. When you're back testing, it's always, you're going to see, when the candle closes, you're going to see what's in front of it. So when this candle is closed, you'll see this. So blue is over red. And so you take your long right here. And then price reaches up here. Okay, and there's your target. So be very careful when you do your back testing that you understand that you understand that part. Whatever you're looking at, this is not what I saw when price closed. This is. You see what I'm saying? Not this, this. And the same thing over here. This is not what I saw when price closed. This is what I saw when price closed, but when the next candle opens, you see this. Okay? Which is a go signal. That's why a lot of times you'll hear, wait for the candle to close. Okay? And all this is confirmation. You don't really trade based on what any of these indicators are telling you. Okay? Don't get sucked into that. It's just like a way to confirm what you think. You don't trade based on these. You trade based on, hey, I think this is going to happen. So let's see if these indicators tell me that too. Okay? And you can just see it. It's like happens repeatedly. This is a good example here of why I liked Bollinger, right? So, or not Bollinger, Stochastic. So you get up here, right? Price spikes up, and then you're like, okay, should I go short? Should I short it here? It doesn't look that good on Stochastic, so I wait. Should I short it on this one? No, it doesn't look that good on Stochastic, so I'm going to wait. I'm going to wait. How about now? Okay, so when this closes, right? When price closes here, you're going to see this, which looks good. So you short it. That's your target. Bam. It's hit. Now you wait. Now you wait. You're waiting, you're waiting, you're waiting, you're waiting. So you're not going to be shorting now. There's no way. Right? Okay, here we go. Now it's time to pay attention again. Price closes below. I see, even though price closes here, I see this. That looks good to me. Take it. That's my target. Follow, follow, follow. Bam. It's hit. All right, now price crosses over here again. This is what I see. It's approaching the 20, so it's almost, and if you look, if you know about candle patterns, you'll say, hey, price is starting to become stagnant along this 20 line. And it's also coming pretty close to being oversold. So you make the choice. Are you going to take the shot or not? Wait, 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 wait. This is what you see. Take it here if you want. And you wait, 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 wait. And it hits for 3. Well, that was garbage. But now you can see price starting to squeeze, right? This is called the Bollinger Squeeze. And all this means is that eventually price is going to have to break out. The one thing, this is something else I kind of didn't like about Bollinger, is sometimes it may give you a false sense that you can just keep trading, you know, constantly trading, constantly, like you should always be in, which isn't right. It's not true. You know what I'm saying? Like, we'll take this little area for example. Price goes all the way up, and you start doing this, and look, it looks good on Stow. It looks good. Obviously, this isn't going to be your target. It's going to B will not be your target. It's going to be C. So you go short here, and you want to hit C. Okay, and everything looks good. In price, even look at Stow, it keeps going down, down, down. And that's just not what happens up on the charts, though. You know, and I think that sometimes it may give you that. I know it certainly used to give me that feeling. So it's just something to look out for. My recommendation is if you want to play with Bollinger Bands, you use it on the lower time frames, and don't trade when price is squeezed like this. Only trade when price looks like this, when there's some distance in between them. You have to learn to make the judgments yourself on what's good. I recommend Stochastic, then RSI if you don't like Stow. I say you don't use MACD. And yeah, so I hope you guys learned something through my babbling. There's probably some good nuggets in there. I'm going to turn this off. And that's going to wrap it up today, ladies and gentlemen. Thank you for stopping by and watching the video. If you want more information on Bollinger Bands, visit the source directly at www.bollingerbands.com. If you have any questions for me, feel free to hit me up at bearforextrading@gmail.com. Follow me on Twitter at bearforex. Visit my Patreon page under bearforex to learn how you too can take part in 4-hour trading, which right now is my safe haven since daily and weekly charts are very boring. And you can visit my blog at www.bearforex.com. Until then, we'll see you next time.